So welcome everybody again. Sorry about that delay at the beginning there. There's lots of noise on the line. So success in trading is a simple mind game, and really that's what it is. I say many times, and I repeat this webinar a number of times. It really is all about psychology and successful trading. So please put some questions in the questions box if you've got any questions that I don't answer, but hopefully we'll have a really good session today. So let's get going. Any issues, technical issues or otherwise, try restarting your GoToWebinar like I've just done. Any issues on anything I don't understand or explain properly, I should say, please email me at webinars@hotforex.com. Okay, so let's get going. So before we get going, let's run through the disclaimer very quickly. This material is provided as a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing investment advice or investment recommendation, or indeed a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in FX and CFD is characterized by a certain degree of uncertainty, that any investment of this nature character involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, and just as importantly, this communication must not be reproduced or further distributed without our prior written permission. Okay, so admin out of the way. A lot of you, let me just check who's in here today before we get going. There's a few new names, but most of you have probably heard me before. My name's Stuart. I'm one of the market analysts here at Hot Forex. My background, I've worked in the City of London for 20 years. I've been trading my own money in investing in stocks and shares and trading Forex since 1997. I had a bit of an epiphany at the end of August that year. 4 key things, and I'm going to talk about these particularly today, the last one, knowing yourself. So do what's probable, keep it simple, look at multiple time frames, but most importantly of all is to know yourself, and that's what I'm going to spend the next hour talking about, and understanding some very simple numbers, because this business, as I say, and I'll say it many times, and I'm not going to apologize for repeating myself, it's a psychological business. It's not about people like me or watching webinars on the internet or watching YouTube videos or getting the very latest robot or EA. It's a psychological business, and you need to understand the basics of margin, leverage, lot size, but most importantly you need to understand yourself and how you approach and accepting losing, and just being comfortable with that, and dealing with it as a business. If you can do that, you can get off first base, as I call it, and you can be successful. If you can't, go and do something else. But there isn't another business in the world where you can get things wrong a lot of the time and still be successful. And again, part of that is the mind games of trading, the psychology of business, because of the way we're built as human beings. It's one of the key issues we have with being a successful trader. Okay, so I'm going to go through how to win, how to lose. You know, it might sound a bit crazy, but they're both the same thing. They're both aspects of your mind, and they're both the two sides of the same coin. How to stay afloat on a trading ocean. You know all about knowing yourself, risk management. Some key numbers, some very key numbers. So before I go much further, can you put in the question box there if anybody is completely new, i.e. you've got less than 3 months experience, and you're still you're still on a demo account, or you've got a live account but less than 3 months experience. Who here has got less than 3 months experience? Okay, there's a few of you answered, not many. A few newbies. Okay. Okay, so if you've survived more than 3 months, there's a few of you here completely new. Okay, so if you've survived more than 3 months, or you're off a demo account, presumably you're doing well, because there's an old adage in this business. 90% of people lose 90% of their money in 90 days, the 390 rule, and a lot of it's true because people don't trust them. Don't understand the basics, and unfortunately, or they risk too much is their principal reason for losing. But I'm going to come on to that more in over the next course of next hour. Elizabeth saying she can't hear me. Hopefully everybody else can. Everybody else okay? Just type Elizabeth a little note. Everybody else says they're okay, Elizabeth. So yeah, yes, 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 says everybody else. Okay, so let's make that a bit bigger. I'll type Elizabeth a little note whilst I'm still trying to talk and type at the same thing. Try. So Jesse Livermore. If you don't know who Jesse Livermore is, the guy on the that's got that quote there. There's nothing like losing all you have in the world for teaching you what not to do. Jesse Livermore, one of the best books you could ever read about trading, and I'll come on to those at the end. And it's, you know, it's timeless. He was he made hundreds and hundreds and thousands of dollars at the beginning of the 20th century. A legendary trader, along with Mr. Dow, J.P. Morgan, and lots of the others. So what I'm going to go through now are 12 things that I got wrong when I started. I did wrong, and I still do some of these now, even today, 20 years later. And I could have put up about 20 or 30 other things. So what I want you to do, even if you're new, those of you that have been here longer than 3 months and survived, score yourself out of this 12, okay? And as I say, I did all of these and more. But be honest with yourself. You've got to be absolutely brutal with yourself and honest, and that's what the market is. The market is absolutely brutal and very, very honest with yourself. Sorry, the market is very, very brutal, and it will very quickly take your money off you if you don't know what you're doing, or you're too risky with it. Or you risk too much, or you get too greedy, or you get too scared. So let's go through these. Why we lose. If we understand why we lose, we can stop losing and then start winning. So we need to understand why we get things wrong, why we lose money. Not in any particular order, except number 4 is the most important in my view. Here is typically lots of people start with too little capital, or invest too little. Or just as importantly, they'll invest 1,000 or whatever it is, the 500, 200, 10,000, and expect to make 500 within a week, or within a day. Some people, expectations are too high, so you can't. The market doesn't work like that. As I say, you need to understand lot size, you need to understand margin, and you need to understand how leverage works, both for you and what can work against you as well. So don't have expectations that are too high, and invest as much as you possibly can without it affecting your day-to-day life. Assume that you might end up losing all of it, and then how would you feel? Well, you wouldn't feel very happy, would you, if you lost it? But if it affects your day-to-day life, you've invested too much. If that isn't enough, save up, stay on the demo account. Second one is, risk too much. We risk 10, 20, 30% of our account when a trade goes wrong. We leave losing trades getting bigger and bigger, and we cut our winning trades quickly because they're suddenly into profit. That's a recipe for disaster. And when people come to me and say, can you help me, I'll look at their trading account, and most reasons they've lost is they haven't used a stop loss, they haven't used a take profit, but most importantly, they've used a lot size that's too big for their account size, and they've risked too much of their entire account on one or two particular trades, and you'll see it all the time. So you can see people that have lots of winning trades, but they're only winning 1 or 2 cents, or $1 or $2, or $10 or $20, but they're having a few big losers. So they might win 80-90% of their trades, but the few big losers are wiping their account out. So don't risk too much. It's all about risk management and money management. I'll talk a lot about that again today. Overtrading, that's something I was very, very guilty of when I first started. Just trying to chase every single trade, trying to get even, having a string of losing trades or a few losing trades, then trying to get back, trying to see you've got you're trading the euro dollar, you see it going up, you jump in, it suddenly turns around, it starts going down. So you see it going down, you're losing. Oh, there's the bottom. You get in, you think, oh, it's going to go back up from here. No, it doesn't. It keeps going down. So, you're chasing it. You're overtrading. Don't overtrade. Don't trade to get even. Don't trade to get losses back, because the market doesn't care. The market doesn't know where you are, where your entry is, where your exit is. It's just the way it is. It goes up, it goes down, it goes sideways. That's what the market does. And you just want to jump on one when it's going up, jump on it when it's going down, and see if you can bounce it when it's going sideways. The trick is obviously knowing when all those things are happening. But again, that's what we're here for. But the most important thing of all these 12 things, or at least 20 things that it took me a while to do after certainly sort of 3-6 months of losing and getting angst and stuff, is not knowing yourself. Really need to understand what sort of person you are. I speak to many people who see scalping as the way forward for them, but but their makeup isn't designed to be a scalper. They haven't got the iron will to cut things very quickly. They haven't got the time to stay staring at the screen very quickly. They get panicked on 1 and 2 minute, 5 minute candles because it's moving too quickly. And so they're not psychologically designed to be a scalper. It sounds easy, scalping, because it's quick. You don't have to stay in it very much. You can close it at the end of the day or close it at the end of the 5 or 6 pips and you've made it. But it isn't, because if you're not designed to do that, it can be very difficult. On the other side, long-term trading again can be a bit boring, or you need a big account if you're going to have big stop losses and big take profits. Lots of people haven't got that account size to be able to do that, and they want the excitement, if you like, of trading more than once or twice a week. So again, if you want the excitement or the energy of closing your trades every day, look at intraday trading. So you need to know what sort of person you are, so what sort of time frame you want to trade on what fits your personality. How often can you look at the markets? If you're working, most of us have a job and work during the day. Excuse me. So the 4-hour time frame, you might be able to look at it between work or something, at breaks or something. That might fit your time scales. But again, that will come down to patience and discipline as well as a key thing. Other ways, most of my personal trading is done on the end of day trades. I'm not really interested in what's going on in the day. I'm looking for big movements and trends and swings, basically. But many people trade intraday as well. I've mentioned this already. Not trading without stop loss, trading without take profit. Again, something I did. Thought I knew better. When it's going down, it'll come back. It's bound to come back. It's bound to come back. And you leave it, and eventually it just gets too big, and eventually you get a margin call which you really, really never want, or you close it with an even bigger loss than it should have been where it was. Or this idea that it's going to come back. Oh, it's okay. It will come back. It'll come back. It'll be okay. And again, lots of people don't trade. Again, I see this all the time. Lots of people don't trade with stop loss or a take profit because there's this nonsense, and it really is nonsense out there, that brokers go looking for. They know where my stop loss is. They know where my take profit is. So they won't let the euro dollar get to 118.20, or they won't let gold get to 12.50 because they know that's where I am. That's nonsense. Absolute nonsense. There is $5.5 billion a day. Sorry, trillion I should say. That's 12 zeros. $5.5 trillion traded in the forex market every single trading day of the year. Now, admittedly, most of that's done between the big banks, but even those as little retail traders, there's still billions and billions of dollars involved. Brokers, hundreds, thousands of brokers around the world, they're not interested in your individual account and where your particular trade is. It's nonsense that brokers go stop hunting. Absolute nonsense. And I'm not saying that because I work for one. I'm just saying it's a fallacy that's held out there in the market. 6 is really, really vital and something I couldn't do, and that is accepting losing. And when that went click in my head, I went to the next level. I went left stage 1 and got to stage 2 very, very quickly. And as I'll show you later, some people can't accept losing, and that's the problem. You've got to accept a losing trade. Just saying 60% win rate's not enough, so accepting that you lose 40% of the time, it's very difficult because of the way we're built as human beings again. We've evolved over time to be winners, to be protectors, especially men. Men find it very, very difficult to lose. That's why women traders tend to, as a percentage of winners and losers, they do much better than men. The problem is there's not enough women trading to make that a significant sample size. So because they tend to risk less and they can accept losing more. Men, we tend to be, because of again the way we've developed and evolved over the millennia, to be the leaders, head of the family, head of the tribe. We've got to protect the family, we've got to protect the tribe, and we've evolved to be fighters. We've got to win at all cost. We can't accept losing. It's not part of our mentality. So we'll take more risks as well as part of that. So women tend to be more nurturing, more caring as mothers by default. Again, the physiology of the difference between men and women. And so they're designed to be, perhaps typically less risk takers and more accepting of losing. You need a trading plan. You know, you can't just think, I want to make money. It's not good enough. You need to write down why you're doing this. What do you want? What is your target? What is, you know, what do you want to do with this? Do you want to buy some land? Do you want to buy a car? Do you want to go put yourself through university? Do you want to put your children through university? You know, you want to get pay for weddings, pay for funerals, pay for retirement, whatever you want to do for it. Forex trading in particular can, it's there to help you. You can do that if you follow some simple rules and stick to it. But most importantly, knowing yourself. So write a trading plan down. It doesn't have to be very long. I've seen them nearly 10 pages. I think is the longest trading plan I've seen. Typically 3 will be enough. One side is probably not enough. Just I want to make money. But write it down, review it, stick it next to your trading platform, understand what it is, and make it work for you as well. 8 is absolutely critical. Some people say patience is part of discipline, or discipline is part of patience. I splitting hairs with the English language there, but basically you need patience and you need discipline. This business, whether you're trading on 1-minute charts or 5-minute charts, or daily charts or longer term frames, it's not a rush. It's very much a marathon and not a sprint race. Okay, you want to be in the money at the end of the hour, or whatever your time frame is. So if you're trading 1 minute, there's still 60 options in that 1 hour, isn't there? If you're trading on the daily, you want to be looking at the end of the month to be up. So patience and discipline. Get your trades on, let them run, give them air, let them breathe. They'll be out of the money. You see many, if you follow anything I do, you see a lot of the time my daily trades are out of the money for a while before they get to target, or they'll shoot off to target straight away, or I'll miss getting in and they'll have already gone to target. So patience and discipline, but got to write it all down as well. That's the other key thing. And finally, timing. If I'd only bought then, and then that's something you can learn. That's something we can teach you. That's what technical analysis helps you with. Or if I'd only bought it yesterday, I'd already done this. I'd have only listened to what happened. So timing can help, and you can learn that. I was very bad at that. When I started, I was trying to trade on 15-minute charts when my data feed was delayed 15 minutes. So I was already 15 minutes out of time, and the market was 15 minutes ahead of me. I had no chance, but I didn't know that at the time. Obviously, times have changed a lot in the last 20 years. The other thing is, 10, people give up too easily as well sometimes because they haven't got enough chance, and it all comes back to this risk thing again. So don't give your system or your ideas long enough to ferment. Giving up after 10 or 20 trades isn't enough. You've got no statistical confidence in that your system or your ideas are going to work or not. In my view, you need at least 100 trades to prove if this system is good enough. And again, you need the patience and the discipline to stick to do 100 trades. That can be done very quickly if you're trading on 5-minute candles, but if you're trading on daily candles, it'll obviously take a longer time for that to come to fruition. But don't give up too quickly, because if you do, your results can be skewed. Again, I can have 5-6 losing trades in a row, and if you're only trading 10 or 20 trades because you're risking too much, and that's usually why the people give up, because they're risking too much. Those 5 trades could happen. There could be the first 5 trades, and in 5 out of the 50 of the 20 trades are losers, and you're 25% loser. And that's out the your money's all gone if you're risking 10% on each trade. Okay. Records. Write everything down. Understand everything. Analyze everything. You're winning trades and you're losing trades. Treat them both the same. Don't get too excited when you win and think you're the best trader in the world. Again, that's what I did, because I think, oh, this is easy. And that's how I started. I just fell into it, and then the market told me a very harsh lesson. Took all my money away from me, or a few accounts. So write it all down, understand it. What I do, I have a page-a-day diary, and I draw a line each day. I draw a line down the middle of the page, and on the left-hand side, I'll write the reason I've taken the trade, why I've taken it, how I felt about it, what were the reasons, the technical reasons, the fundamental reasons, and how I felt emotionally about it. So what, was it 100%? Was it a 60% feel? What was going on in my head? And then on the right-hand side, I'll write the result of that, why it went successfully or why it went unsuccessfully. And it's very, very hard, but I try and treat them both the same. I accept losing, which I do now very, very comfortably, and just winning is part of the business. If you concentrate on the losing trades, It might sound like an old cliche, but the winners will take care of themselves. And I'll show you the numbers to back this up. This is not just nonsense. It's not just blah blah from an old guy sat in an office in Cyprus. This makes sense and it works for me. And I say these are 12 things I've done, and I could have written 20. I'm sure those of you that are here that have got more than 3 months experience, and even those of you that are just beginners, I'm sure you have done some of these numbers. And I say I score 12 out of 12. But you know, for that final one there about understanding the simple numbers, what is a pip? What is a lot size? What is risk management? What does all that mean? How does it all affect me? What does you got to understand? You really owe it to yourself to understand that, and understand how how risky trading can be, especially forex trading. But what the returns can be very, very lucrative as well if you get this right. If you understand yourself principally, the rest of it falls into place after that. Honestly, so I say I don't know. I've got 2 blank slides here with, I was going to write 20 things, but I thought I'd end up dribbling on for too long. But I'm sure, again, a lot of you out there will. I don't know how. I mean, who would score 12 out of 12 on that? Let's be honest. Those of you that have been trading, even the beginners out there, who would get 12 out of 12? And what sort of score would you get on those 12 dirty dozen, as I call them, things? So not enough money, too much risk, over trading, not really knowing yourself, no stop loss, no take profit, accepting losing, no trading plan, poor timing, patience, quitting too early, not writing anything down, not understanding those numbers. Again, at the beginning, I still, I say 12. So, absolutely. So now you know why you lose. That's what we can address now, and that's what I'm here for. Okay. I can help you with all of these things. So I've been there, I've done it, and I've come through the other side. And it's all about, as I say, knowing yourself, and that's the key thing. Okay? I say I could have wrote loads more as well. That's why I've got these other 2 slides here. So somebody's put on here these 7 out of 12, 5. Okay, well that's great. If you're down there, that's fantastic. You're much further ahead than I was when I started. Or I don't know how many years trade experience you guys have got, or months trading you guys have got, but excellent. And those of you that have put 12 in there, I am with you. It happens. But now, write it all down and address it. What is the key thing? You've got to look yourself in the mirror and say, can I do this? The answer is most people can, but the trouble is most people don't follow the rules or don't stick to the rules. So that's why they end up losing, unfortunately. So 3 criteria you should always focus on. Now I'm going to go through this over and over again. It gets a bit boring, but it's true. Why isn't it moving? Know yourself, understand your belief pattern, because the market, that's what it's driven by. Whether you believe it's very much computer driven these days, and it is, lots of automated systems, but remember those systems, those computer systems, those computer programs are written by people, and people are emotional beasts, and we all have those same belief patterns. If you think something's going to go up, you buy it. If you think something's going to go down, you sell it. As simple as that. And the market exists, the broker exists to put those 2 belief patterns together. So one side guy saying sell and at this price, another guy saying I want to buy at this price. Broker, us, put them together. Thank you very much. We got a trade going on, and that's all the marketplace is. Whether you're selling currencies, copper, apples, or I don't know, building sites, it's exactly the same. There's a buyer and a seller, and that's what creates a market, and that's all it is. And you just got to understand, somebody thinks there's value in something, he'll buy it. If somebody thinks there isn't, they'll sell it. So risk management, absolutely vital, and I can't talk about it enough. My 1% rule will come to in a minute, or in a few minutes. Do what is probable. I talk about that all the time. So instead of thinking about winning dollars or losing dollars, think about percentages. It's all in the numbers, especially the percentages, because the size of your account doesn't really matter in that sense. Okay, obviously you need a minimum amount to make this successful and make the numbers make sense. But if you can do this with $5,000, all you do is repeat it with a bigger number. So put a naught on the end, you can do it with $50,000. I'll take a naught off, do it with $500. You can prove it to yourself. You can do it with $500. It's exactly the same with doing it with $5,000 or $50,000 or $500,000. Because the process is exactly the same. And that's what successful traders do. They repeat things day in, day out. That's why you see, these broken rooms where they look like they're not doing anything all day. It's because they're not, to be honest. they'll trade, and not very often to be honest, but there'll be big positions. They'll move into positions and they'll move out of positions. So as a trend develops, goes through they'll add more value. So that's why sometimes you see when trades get to big high positions, you think can't get any higher. Well, they do, because the big players are pushing it higher again, because the trend is running and they're often running and they're adding to that position. So know yourself, timing and time. So when do you want to trade? Do you want to trade all day? Do you want to sit in front of a screen all day? Can you sit in front of the scene? Trade around your work. Trade when you can, not when you want to, and always beware of these time zone changes, especially in Forex, because the opening of London is probably one of the most key parts of the day. Before London opens, we've got a very low liquidity in the Asian session, the Sydney, the Tokyo session, low liquidity, concentration on obviously the Asian currencies, the yen and the Aussie and the New Zealand dollar in particular. London wakes up, Europe wakes up, the big volumes come in, the liquidity takes on, you'll see lots of volatility is trading. And same when America wakes up, we have the same sort of thing. America comes in, and that's the big deep liquidity of the day. New York's open, London's open. London's the centre of all Forex trading, always has been, and even with Brexit probably will maintain that. So that's the key function, and that's the key trading zone or trading time frame, is the London session and the New York morning session. So as London starts to close at 5 and 6 PM GMT, that's when the liquidity starts to slow down. We've still got America up and running, and then we get these crazy spikes sometimes, sort of 11 o'clock, 12 o'clock GMT, when the liquidity is very low. New York's closing down, Tokyo's just opening, Sydney's just opening, and that's sometimes when we get these crazy moves when the liquidity is very low. So trade when you can, not necessarily when you want to. So fit it in around you, your time scale, and what you're doing, and look at the time frame that fits you. 2 or 3 times a day, once a day. Be a scalper if you want to be, if that fits you. So make it fit with you. But you've got to reduce yourself, know yourself I should say, and reducing emotion is absolutely vital. We can't get rid of it all together, because that's how we're based. Like I said earlier, we're psychological beasts, we're physiologically designed as human beings, made of blood and water and flesh and all the rest, and bones. But the 2 key emotions that drive the markets and have always driven financial markets are fear and greed. People talk about hope and regret as well, but hope and regret keeping out of trading. But it's fear and greed that drive the markets, and we're dominated by our emotions, and particularly as traders. So we've got to learn we can't get rid of it altogether, but we learn to manage it, okay, and accept the fear and the greed. Can't get rid of it, we just got to manage it, okay. 3 types of fear, principally in the market. The fear of making a loss, that makes sense. You open a trade. You look at it, you're watching it, it's always great, it's always red. Remember, the psychology of that is because of the spread, every time you open a trade, you're always out of pocket. That is the nature of trading, that's the nature of the spread. So if you're watching that, however long you're trading, you're watching that, it's always negative. That's digging away at your psychology. So one tip would be to don't look at the profit and loss column. Don't look at the red when it's red. And don't look at it when it's green, because your impulse then to close it. So you do all your thinking before you open a trade. Put your stop loss on, put your take profit on, and let it run. It might be out of the money for a while. If it hits its stop loss, that shouldn't bother you, because the loss should be a manageable loss. And again, I'll come on to that in a minute. So 3 types of fear. The making of a loss, that makes sense, doesn't it? When you actually open a trade. Actually missing a trade, that's another thing that really bugs people. If you've got your little system set up, and I'm going to wait for the hourly candles, but you're away for that particular hour, or you miss the end of that next 4-hour candle because you're out walking the dog or whatever, or you're at work, and it triggered your system. That's things that, oh God, if I'd only just got in then. Can I get in now? Well, you shouldn't really. If your system's based on the 1-hour candle, it's triggered then, or the 4-hour candle, you should really wait till the next one closes before you make a decision. But the one that really bugs you is the losing a profit. That's the fear, and that's a really one that eats away and can be most destructive at all. Because if you're watching that trade, or you got a trade on for a few hours or a few days, even, and first day it's in profit, second day it's in profit, that's great, and then the third day it suddenly goes back to your entry, and then the 4th day it's out of profit, and then the 5th day it's out of profit, and then the 6th day it hits your stop loss. First 2 or 3 days I was in profit. Why didn't I close it then? That's the sort of thing that eats away at you. And it's regardless of the time frame, it's the same principle. On the 5-minute time candle, the same thing. First 4 or 5 minutes you're out with the profit. Oh, that's good. Next 4 or 5 minutes you're in profit. That's good. And then it goes back down again. And it goes back down again. And then eventually it hits your stop loss. Or you close out because it's losing too much. But I was in profit. Why didn't I close it then? And that's what eats away at you. The fear. So 3 principal fears: loss, making a loss, missing a trade, and losing a profit that you've already had. Greed is the other side of that same coin, and it's a 2 principal emotions that drive the market: fear and greed. If you've ever seen the film a long time ago now, Greed is Good, Michael Douglas's Gordon Gekko. Greed is good, he infamously said in 1987. No, it's not, said Stewart in 2000 when I got hit quite hard. That I did a very similar thing. Kept hold of things too long. Made a lot of money, but thought it was going to go on forever. Couldn't get out quick enough for some. So greed, you've got to manage it as well. So deciding when to trade can be easy. And for me personally, this is again for me personally, and I'm sure this is correct as a psychological approach, a physiological approach, because of the way we're built as human beings, is that longer time frames involve less emotion and therefore should be better decisions. Not always and not for all people, but in general, and certainly for me, the longer time frames involves less emotion and better decisions, because I can, put things on with a bit more in a more of a relaxed mode. But think about it. Does that apply to you as well? If it does, fine. If it doesn't, well, great. Look at these in these shorter time frames. Risk management, number 2, is absolutely vital. I've talked about I'll talk about doing what's probably in a minute, but the risk, vital. We'll look at that in a bit more detail. So some old cliches, but they're all true. Scared money never wins. Trade what you can afford to lose. Don't use borrowed money. Because in the back of your mind all the time, you've got this worry about if you've borrowed money, or it's on your credit card, or it's money you can't really afford to lose. You're not going to be able to pay the rent or pay the mortgage, or oh god, the holiday's going to go that we've saved up for. That is banging away at the back of your mind all the time, and it's this little voice in your head, the subconscious, which I'll talk about more in a minute, that really eats away at you. Because trading can be quite a lonely, independent sort of business. So yes, there's lots of social trading platforms now. There's lots of mentors out there. Obviously, we do as much to support you as possible, and we're here. And it's all free of charge. We're here to help, and we want you to be successful. Because if you're successful, we're successful. We want you to withdraw your funds and go and tell your friends what a great broker Hot Forex is. I got my money back straight away, and I've gone and spent it on a new car, or put the kids through university now, all that sort of stuff. All good stuff for us, but you've got to manage your risk. You've got to have the 3 PDC: patience, discipline, and control. Old, boring, traditional words, but that's what drives the market. Even the excitable, quick, high volume scalpers still have patience, discipline, and control, and to an extent they need it even more, because they've got to be very, very disciplined. They've got to be very, very cutthroat when you're trading on very, very short time frames. So patience, you've got to wait for your levels, your indicators, and your candles to close many, many, many times. And I'm still guilty of this myself, 20 years later, of jumping in before the candles closed, before the hour's up, or before the 4 hours up, or before the day closes sometimes. Obviously, the higher the time frame, the less significant it is. But if you're trading on shorter time frames and you've decided to trade on 5-minute candles, well, wait till that 5 minutes finish. Just because the last 5 were over some indicator, the next 5 could suddenly dip down. So you've got to wait. You've got to have patience. You've got to have discipline, and you've got to have control. So wait for your levels, your indicators, your approach, whatever that is, to work for you. You've got to stick to your plan. There's no point, as I said at the beginning, having a plan and then chopping and changing it, suddenly deciding, well, the 5-minute time frame isn't working for me, I'm going to go to the 15-minute time frame and trying 5 or 6 trades on that, and that didn't work. Oh well, let's go up to the hour time frame. That seems to be working okay, but you haven't got much money left in your account now because you've risked it all in the lower time frames. And all right, well, I'll risk more on these 1 hour trades, but they seem to be going okay. But because I only had 30% of my money left, I didn't have long enough to trade on the 1 hour time frame, because I'd risked too much in the first. I was risking too much because I didn't have enough left, because I'd I wasn't sure what time frames worked for me. So stick to your plan. Give it time. Give those 5-minute trades. The 100 trades I talked about to make sure whether it does work or it doesn't work. And control. Fear and greed, the two key things that drive the market. You've got to control your emotions. Emotional trading is bad trading. Emotions make bad traders. You've got to get rid of it all. And again, by default, I'm quite an emotional guy, and it's the wrong sort of psychology you have as a trader. But once I realised that, I approach my trading very, very differently, and I manage it. Some of the best traders I know are the most, with all due respect to them, I'm sure they don't mind me saying this, are the most boring people in the world, because they're very disciplined, they're very automatic in what they do, but they're very, very good traders. One of the best traders I've ever seen is an old lady. I'm saying she's an old, well, she will be an old lady now. She was quite old when I met her. She used to be a camerawoman for the BBC. Quit to or retired early. She had a good pension from the BBC, but she really liked trading. But her real passion was photography, and trading has given her the time to pursue her passion, because she's very unemotional, she's very clinical, very cutthroat trader, and it frees her up to go wandering around the world taking fantastic photographs. And that, I met her many years ago, and she's still the same today. But you wouldn't know that she was a very, very disciplined, very professional, very effective trader. She just looks like any old other lady in her 70s, quite nicely dressed, but not over the top at all. So how do we do all this sort of stuff, this risk management, this managing your emotions, all this sort? Well, it helps if you're not risking too much. And by not risking too much, it takes the fear away. Because if you can afford to lose 1%, and you should be able to lose 4% of your account, 1% of your account, it shouldn't bother you. Do it 4 or 5 times in a row, you've lost 5, 6%. Even that shouldn't be bothering you, and you've had 6 losing trades in a row. In that situation, it won't be the money you've lost, the 5 or 6% you've lost. It'll be the fact you've lost 5 times in a row. That's the thing that will unhinge you or will trip you up in the long run. So my 1% rule is very, very simple. If you don't want to use 1% of your account, use a fixed money, okay? $50, $5, $500, depending on what your account is, and make the take profit and the stop loss and the lot size fit that rule, okay? Please explain the 1% risk management using a $100 account. Elizabeth, well, what's 1% of $100? You should be able to answer that, shouldn't you? Mark's put here, currently my risk is 0.1%. Well, that's fantastic, Mark. If you only reach 0.1% on each trade, that's very, very low risk, very, very conservative approach. But do you get enough trades, Mark? That's the other thing. Do you get enough return? Because there's the other flip side I haven't talked about, and I talked about over trading, is under trading. Because the other thing some people do is they wait for all the indicators to fit, all 10 things that they've got wanting to go before they'll hold themselves back in that sense. Elizabeth, you haven't answered me, but I guess $100 is very, very difficult to trade forex with $100. Oh, I'm still developing as a trader, says Mark. Okay, well, yeah. Well, think about that. Risk is very low, Mark. It's you might want to think about improving that. I don't know if you're playing with it, if you're developing a system or developing yourself as a trader. But 0.1% of your account is very, very small. But if it works for you, fine. But let me just run through this 1% rule, okay? So let's assume your account is 5,000, Elizabeth. So the percentage doesn't, the number doesn't matter in that sense, but you do need more than $100, Elizabeth, if you're going to try and do this full time. If you haven't got that now, save up, go and get some more to invest, and practice with a demo account, because the principles are exactly the same. The problem with a demo account, 2 key things with a demo account. One is the size can be unrealistic. $50,000. If you haven't got $50,000, don't try and trade with a $50,000 account. Trade with something more approachable. And the second thing is, again, the psychology is that in the back of your head, your subconscious, that it is a demo account. It's not real money that you're risking. That's the difference. The palms don't get that sweaty, or the heart doesn't race too much, or the pulse doesn't start pulsing when you're only dealing with a demo account, because it's not really real, and your subconscious knows that, so you play tricks with yourself. But let me run through this, doing what is probable and thinking percentages. So ruling out let's just think in percentages for a minute. So our risk management rule is 1%. So 1% of 5,000 is 50. Let's do this. So let's assume we do 2 trades a day, 10 trades a week, 520 trades a year. Okay. If I go through this too quickly, ask me to do it again. But sometimes I go through it too slowly for people as well. So I can be a bit labour things a bit too much. Let's assume we win 6 out of 10 trades. That's a pretty good win rate. Okay. But let's just say so. I say most people find that very difficult to cope with, even though that's a good win rate, to be honest, because it's not the winning, it's the losing that gets them. Also assume we're looking at a risk ratio, a risk reward ratio of 1 to 1.5. So if we lose 50 of our 5,000 or 1%, we want to win 1.5%, okay, or 1.5. So if we're risking $50, €50, 50 rand, we want to win something like 75. Or let's assume in this case we're going to win 75. Okay, so we lose 50 every time we lose, and we win 75 every time we win, and we win 60% of our trades. So the numbers run out like this. We do 2 trades away, and we trade every week of the year and do 500 trades. So our winning trades, 60% of the 520 trades, we win 75. So we win 23,400. Our losing trades on the other side, the other 40%, give us a loss of 10,400. So we started with 5,000, we've won 23, we've lost 10, and we end up with 13,000. Yes, so 23 minus 10,400 gives us 13,000, which is 1,800 a month. If we started with 5,000, 1,080 a month is 21% per month, or 260% a year. Just leave that on there to let those numbers fill in, okay? So it's that simple. You've got to understand these simple numbers and understand what your risk reward ratio is, what your win ratio is. Not necessarily pips, but your win ratio. And most importantly of all is this number up here, the risk management rule. Okay, so that's on that account size, that's on that ratio, those sort of ratios. What if we changed it? So 260% a year. Even, this is my point here, this is the real point of today, these last 2 lines here. Even if we lose half of our trades, 50% of our trades, 5 out of 10 we lose, we still end up, and we lose our win ratio drops to, instead of 1.5 we drop it to 1.2. So we lose 50, we only win 60. Okay, 1.2%. Does that make sense, everybody? Ratios, thinking ratios and percentages. Remember, forget about the dollar numbers. We still make 4% a month, or 52% a year. So if we start with $5,000, we'll end up with $7,200 in a year, losing 50% of the time. And we make 4% a month. The central banks are, your money in your bank account is earning negative interest rates in parts of Europe and Switzerland and Japan, many parts of the world. Even in the UK and America, you're only getting 0.5% or 1% a year if you're lucky. Getting trading wrong 50% of the time, i.e. half the time, and not winning very much, you still make a good return at the end of the year. It's that simple, honestly. If you understand these numbers, you really will get off first base and onto second base quite easily. But you've got to understand your numbers and stick to your numbers. Okay? I don't know what jobs you guys out there do, but just imagine if you're an accountant or a solicitor or you're a pilot, and you got things wrong 50% of the time. Do you know a good accountant that gets his books wrong 50% of the time? Of course you don't. A solicitor that got 50% of his cases wrong, he'd be out on his ear, wouldn't he? So think about in your terms. What do you do as a job? I don't know if you've got engineers out there. Engineers are particularly, that they're driven by numbers. They don't get things wrong 50% of the time. But in this crazy business, you can do that and still be a winner. And that's what makes trading different to anything else you've ever done or anything else you will ever do. It's not a job in that sense. One of the hardest things I find when I was trading from home, my wife would come in. She's a teacher. She's been a teacher for many years now. What have you done today, darling? Nothing. What do you mean nothing? Well, nothing, because nothing triggered in my system, so I didn't do anything. And that's really, really hard as well as a trader, not actually doing anything and telling your loved ones about that as well, as if that's a job. But you can't think of it as a job in that sense. Okay. So the 1% rule, and send you this little, very, very simple little Excel spreadsheet, and this is what many people don't understand, won't accept, and ignore. But you've got to know these very, very simple numbers, and that, you know, you don't need a degree in maths to understand this. So here, this is why many people get things wrong. They'll end up risking too much, 10% risk for a 5% return, and they very quickly empty their account. So these are the two examples we just talked about, the 1% rule. Look, if you get good, you know, profit per trade's up to 2%, your win rate is 60%, still doing the same number of trades, you know, 500% return. The black line is my sort of current numbers. I'm currently winning profit per trade of the trades I've done is about 2.14%. I think this is rounded it down to 2.2%. And my success ratio is, actually it's not that high, it's 67. I thought I'd change this. I thought I'd change this before, right? Before we put this up, but it's not 70%, it's about 0.67% at the moment, 67% win rate at the moment. So, but you know, 700% win rate. The trouble is, most traders end up in this side of the equation. They'll risk too much, far too much to their account, and end up losing. So if you're risking 10%, let me ask you a very, very simple question. Might be a prize for those that answers firstly. The first, how many trades can you get wrong if you risk 10% on each trade? How many chances do you get before you empty your account if you're risking 10% of your account on a trade? Come on, quickly, if you're still listening. Bravo, Blessing was first. Well done, Blessing. I'll send you an email with my congratulations. 10, exactly, 10 chances. Next simple question. Well done, guys. Next simple question. If you're like, you know, you stick to the rule and you're only risking 1% of your account on each trade, how many chances do you get before you empty your account? Bravo, Blessings in like flint. Well done. I think you guessed what I was going to say. Honestly, think about it. It's that simple. So concentrate on the risk per trade. Concentrate on reducing the risk. If it means you can't take a trade because you haven't got enough money in your account, don't take the trade. But at the same time, write it down and see how it would have performed if you did have the money, and that gives you the incentive to save up and put some more money in the account. And that's what micro lots are all about, 0.01. It allows very small accounts, not very small accounts, but small accounts to stick to these rules. Obviously, Bernard's put on the point, it's much more likely to have 10 losers in a row than 100 losers. Yes, that absolutely, Bernard. You don't have, I mean, I haven't had 10 losing trades in a row, touch wood, for a long time. I think 4 or 5, 6 is the worst I've had for the last few years. But that's not the point, Bernie. I'm sort of making a point, and obviously that's assuming every trade you have is losing. Even 10 trades, the probability is that 1 or 2 of them will win. Okay, so you'll win a bit, but the probability is that winning trade won't be much. My point is that the lower your risk, the longer you will stay in business, the longer you will get experience with real money, and therefore the more chance you have of learning and becoming a better trader or becoming a trader. Because as I say at the beginning, many people give up too quickly because they risk too much, more than 2, 3, 4%. They use a lot size that's not appropriate for their account. They'll start trading full lots when they've only got $500 in their account. They clearly don't understand the risk that is involved. You know, if they've got a leverage of 500 or something, a leverage of 500 with $500 and trading full lots will empty your account instantly if you've even got the margin to do that. That's what you need to. That's what you need to grab. Bernard? I don't sound. This is my greatest challenge. What's your greatest challenge, Bernard? Keeping risk low. Why? Why do you say that, Bernard? It shouldn't be. The risk management is absolutely key. If you don't, you won't have a long-term future in this business. Why? Ask yourself. I'm asking you it now in front of everybody. Nobody obviously can see what you're writing or anything. But if you don't want me to repeat the answer, I'm happy not to do that, obviously. But if you want me to drop you an email, I'm happy to do that as well when we speak one-to-one. But understand investors' mindset. I'm not quite sure what you mean by that. Oh, sorry, that's somebody else. That's but let me just see these questions up a bit bigger. Let me just. Oh, my PC's not playing games here. I can't make the question box bigger for some reason. Let's read all your questions before we move on. Yes, our Wiener's put here. My challenge is greediness. Absolutely. As long as you know that now. Now you've written that down, Wiener. How do you feel about it? Because now you've brought it from your subconscious to the front part of your brain, your conscious brain. So write it down. I'm a greedy person. I need to stop being greedy. So next time you put a trade on, instead of putting it at whatever many pips up or whatever you think the take profit should be, bring it down a bit. Bonus, I tend to invest in a trade and think that it will ultimately go to my way. It's my ego. Well, again, that Bernard, I'm sure my ego states it will turn around. Well, like we said on that spreadsheet, that's what losing traders do, Bernard. They assume or they hope. I said don't. Hope and regret not in a trader's mindset. Don't use the word hope. When you open a trade, it either will or it won't. It'll go to the take profit or it'll get to the stop loss. It'll do what it needs to do, and it will do that. And if you have the stop loss at a position where you're only going to lose 1 or 2% of your account, you live to fight another day. Okay, that's interesting, Bernard. Bernard's wrote here, do you mind me if I repeat that out with everybody? Because that's a really good point, Bernard, you put in there. Okay, Bernard's wrote here, the only way I've learned to survive is to use, and that's a great word as well, survive. Think about what you've written there, Bernard, as well. The only way that I've learned to survive is to use entry orders with predefined stop loss and take profit. Exactly, because all the thinking then, Bernard, is being taken away from you. The market either gets to your entry point or it doesn't. And all that emotion, therefore, should have been taken away, because the stop loss should be at a point, and I'll repeat this, I've probably said it 5 times already in this hour, I'll say it again, should be a point where you lose 1 or 2% of your account. And it doesn't matter, well, it does matter if it gets it, obviously it's a loser, but you learn from those losing trades as well. And you live to fight another day. So Bernard, that's a really, really good point. How can a trade handle the addictive aspects of trading? It's a really good question as well, Raymond. Well, you've got to ask yourself that again. What addictive is another really difficult word. The whole market is the whole forex market. Sorry, the whole trading market is set up as well to make it. I probably shouldn't say this, but the marketing of it is could be a bit more honest. Let's put it like that. But you've got to accept that the market is open 24 hours a day, and you can, so it's available for you. So you've got to ask yourself, do I need to take this trade now? Does it fit my criteria, or am I just gambling, or am I just hunting for a trade? That's the other thing. One of the things that the 13 to 20 points I didn't put on there is. Sorry, what time is it? It's gone past the hour, hasn't it? I'm talking too long again as usual. But if you're happy to stay, I'm happy to keep talking. So. I'm sorry it's run over the hour, but what was I saying? I was asking Raymond's question. Yes, this addictive nature of trading. Well, just take a step back, take a breather, go and go for a walk around the house, go for a walk down the street or something. Go for a swim or go for a run or something. Get away from it, but fit it into your lifestyle. Fit it to the time frames that you're trading. If you think it's becoming too addictive, look at your trades, write them all down. It'll slow you down. Is that fitting with your timescale? Biggest challenge in understanding market movers mindset. How can I cope with that? I'm not quite sure what you mean by market movers mindset. You've got to understand yourself first, ABAC. That's the most important thing. It's not you. It's not It's not the market. It's not the trader. It's not the broker. It's not what Goldman Sachs thinks. It's what you think, and it's how you do that. Bernard, I've lost accounts in the past. Years of savings life, so I've had to look at in terms of literal survival. Well, that's interesting as well. I've been there as well with you, Bernard, as well. And it's writing down why it happened. Okay. Yeah, that's a very good point, actually, Bernard. I might do that, actually. Bernard's wrote down here, perhaps one day you'll present a webinar on your own progress as a trader, Stuart. Bernard, if you come to my seminars, we meet face-to-face, I tell you the story of how I got started, why I got started. It was a bit of an epiphany for me and my family, and the losses I went through. Again, I've put them on here. Sorry, let's go. These, I was like, we have all these 12 things on here. Oh dear me! I've done all these. I lost considerable amount of money of my capital I had at the time. Didn't invest enough, risked too much, over traded. Didn't really understand what I was like as a trader. Didn't understand the emotional way I was built up. Trading with data that was information that was way out of date. Couldn't accept losing. That was a big thing for me. And I think it's a big thing for many male traders, this acceptance of only winning 60%, and it's not the winning, it's the losing, the 40% losing it gets your head. And hopefully with those numbers I've just shown you, you can do it with even 50% and not we're not winning enough. So I'll do that. I'll perhaps do that one. Is the 1% based on the distance between the entry price and stock? No, Elizabeth. The 1%, Elizabeth, I'll drop you an email. The 1% is based on the size of your account. With $100, I can't tell you what to do, Elizabeth, but you're going to very quickly lose that money. Leave it in your account. Go to your demo account and save up and put as much in as you can in before you start risking your real money and use the 1%. So, if you had a demo account, Elizabeth, let's just come down. Put 5,000 in your demo account and stick to this rule. So, every time in simple terms, every time your trade gets to $50 losing, close it. Okay, how about that? And tell me how you get on from that. Put 5,000 or put 50,000 and every time it gets to 500, lose it, close it. So use 50,000, use a one lot trade size just to keep things simple, and every time the loss gets to 500, close it. That's the 1% rule. Okay, don't trade with your $100 because you'll lose it very quickly. My trading philosophies are 4. There's no sound, somebody said again. Oh dear. It's just you. I think risk management, patience, discipline, emotion and control. Absolutely. Risk management, patience, discipline, control, emotion control. Absolutely. No question about it. Like I've said before. So let's just finish this presentation. I've lost track of time. It's gone. I'll say it's gone over there. So risk and money management is everything. Okay, it really is. Successful traders, you can pile it all into these fundamentals, the sentiment, the technicals. But risk management, probabilities, percentages, absolutely vital for success. Timing you can learn. That's technical analysis. Come to our webinars. Watch what I do. After lunch, this must be an old slide. I don't know what that means. Live trading. Well, that was from a seminar. I've obviously got this. I've pulled this one from a seminar I've done. So after lunch, I actually showed people on live markets what I was doing, and when we did it on a Saturday, it was obviously what I had done that week. But anyway, fundamentals moves, but risk management absolutely vital. And once that penny drops, once you understand those simple numbers I talked about, it'll be very successful. We got all sorts of ways to help you. Okay. Education, we got webinars, there's videos, there's recorded webinars, there's our market analysis, the videos say up on YouTube, our analysis website. Do I do one-on-one seminars? I will do one-on-one seminars. That's usually VIP clients with 20,000 in their account. So I can do that, but join me on Facebook, and you can see what I do on Facebook as well. Stuart Hot Forex Cowls on Facebook as well. I put a lot of stuff up on there, as well as on the analysis page. Most of the stuff's up on the analysis page. This is an old slide because Andrew's little face is missing off there. Bless. Facebook, Stuart Hot Forex Cowl. Friend me, and you see all the stuff I put up on there. Put stuff on there. These webinars are free 3 times a week. Once a week I do live analysis. Yesterday we identified 3 really good trades that have all triggered last night on the daily time frame. One's already hit both target 1 and target 2 for nearly 100 pips. The other 2 are one's in the money, and I can't remember what the other one was, but anyway, I think that's out of the money, is it? Our app is really good. Get that on your phone. Now then, books. And again, those of you who have heard me before will have seen before, but if you only ever buy one trading book, buy this one, Edwin Lever, The Reminiscences of a Stock Operator. Okay, and the other one you should have a look at is Mark Douglas, The Trading in the Zone, this one here. Both these two are out of print, and you can get them as free PDF downloads. Okay, so you don't even have to buy the book. But don't tell people I told you that, and because I'll have the publishers chasing me. But Reminiscent Stock Operator, story of Jesse Livermore, absolutely legendary trader. 90 years old, this book now. 70, 80, 90 years old, out of print, but fantastic book. All about the mindset of trading, and some classic quotes in there that I use all the time as well, and absolutely timeless. The markets haven't changed because the markets are driven by people, and people are the same. If you want a copy of that little spreadsheet I've done as well, just put a note in the question box, and I'll email you one afterwards, or I'll attach as a PDF to in there as well. Intelligent Investor, it's what Dr. Ben Graham, it's what Warren Buffett bases in long-term investment ideals on. Another classic book. Schwager interviews with successful traders, commodity traders, stock traders, futures traders from the 80s and the 90s. Priceless books. Jack Schwager still around, still writing books. Big futures trader, very, very successful. Alexander Elder and Kay Van Tharp, great teachers of traders. Again, based on stocks particularly. Trading for a living, come to my trading room, trade your way to financial freedom. All of these books have been updated, all from the early 20s and 90s. Again, I've got all these books, and very, very good, all of them. Michael Lewis is a great author about the trading business. His latest, well, his most famous book probably is The Big Short, that was turned into a film, the Oscar-winning film about the financial collapse. Great book. Better than the film, but the film was pretty good as well. Flash Boys, even better book for me, all about high frequency traders, the more up to date boys, front running. He didn't call them cheats, but basically the front running orders. Will make a great film as well. I don't know whether there actually will, but a great book as well. Great writer on the financial markets, Michael Lewis. I've just finished one of his latest books, The Undoing Project, over the summer. A fantastic book as well, about two Israeli psychologists that really literally changed the world and changed how we think. Nicholas Taleb is a big probability man, options trader himself. He's a professor of, I think he's actually, I'm not sure what his proper title is, but he's a Lebanese guy based in the States. Black Swan, The Black Swan was his big famous book, but also Fooled by Randomness is a great book as well. Ascent of Money is all about the history of money, and the last chapter is the one that really grabbed me. It's all about Neil Ferguson, another academic Scottish historian based in America. Talked about the final two chapters. He calls it Chai America, the rise of America and China as the new financial powerhouses. Very, very interesting. If you're completely new to trading, this book by Anna Cooling is a really good one, Forex for Beginners. She has a very, very similar philosophy to me. She runs a website, annacooling.com, with her husband Dave. Very, very nice couple. Great teachers. David's an engineer by training. I'm not sure what Anna is actually by training, but David's an engineer. Volumists, they're very much about volume and volume telling you everything, and they're right. They trade very much on the futures market as well. So she's got three other books actually. One's about binary options. The other two are about volume and a bit more technical, the volume price analysis basically, and that's her approach to trading. They've written some apps as well. I had some apps written for them for MT4 platforms. So really good books if you're a beginner as well. So I've run over time, so I won't run through these Jesse Livermore quotes, but everybody will get a copy of this presentation. If you want a copy of the spreadsheet, that very simple, as I say, very, very simple spreadsheet, let me know and I'll send it to you. But understand those numbers honestly. But it's all about understanding yourself, this business, and if you can do that, you can be successful. You can get off the first stage of successful trade. So any questions I haven't covered, or if you want that spreadsheet, email me at webinars@forex.com. It's probably the quickest way to get a response, and we'll get to you as soon as we can. Okay, so thank you for your time. Any more questions before I close? I appreciate I've gone over time, but we were a bit late starting. So any final questions before we go? Anything I haven't answered? Anything that doesn't make sense? Yes, please, can you send me the spreadsheet? Certainly, Abraham, I will do that. Bernard, thank you very much for your kind comments. I need a copy of the webinar. I say everybody will get